The AI bubble is spooking the markets recently. But should you be worried? Let's break down all you need to know. Remember to like and subscribe if you love the video. You might have heard that US was showing flashing signs of recession, but somehow it ended up having a soft landing. Well, AI could be one of the major reasons, but not AI products. I'm talking about the AI spending and capex. In the first half of 2025, AI-related capital spending contributed 1.1% to the US GDP growth according to JP Morgan. It actually outpaced US consumer growth engine, and it's not just GDP. JP Morgan's Michael Sembalist notes that AI-related stocks have driven 75% of S&P 500 returns and 90% of capital spending growth since ChatGPT launched in late 2022. You've heard about the circular deals forming. Let's break down this through an example of AMD and OpenAI. In 2025, OpenAI and AMD signed a multi-billion-dollar partnership. OpenAI agreed to buy up to 6 gigawatts worth of AMD AI chips. In return, AMD gave OpenAI warrants to buy up to 160 million AMD shares at a price of zero point 0.1 cent per share, which is practically free. So AMD gets a huge revenue to show off, thus increasing their valuations. OpenAI gets the warrants, which they would convert to shares as they fulfill their commitments of buying the chips. So who ultimately paid? The shareholders of AMD whose shares got diluted. Let me be clear. It's not fraudulent, but you can see the circular structure and the ultimate payer. Similar deals have been popping across this space. NVIDIA invests $100 billion in OpenAI. OpenAI commits $300 billion in Oracle, financed in part by Oracle buying NVIDIA chips, and so on. So there are some parallels to the 2000 dot-com bubble. In the dot-com era, startups bought each other's ads and services to inflate revenue and growth. Banks and investors built complex chains of exposure, and once the link broke, the whole system shook. There's tons of optimism priced in future profits, and currently they're burning cash at a record pace. Estimates suggest around $400 billion are going to be spent on AI data centers alone. It roughly could translate into $40 billion in depreciation. And the current revenue from these companies? Around $15 to $20 billion. It means the depreciation is around 2 times of revenue. The sector has to at least 2 to 3 exits revenue just to cover the wear and tear on the hardware. To make matters worse, several analyses peg global AI capex heading toward 1 trillion over just a few years. Assume investors require a 10% annual return on that capital. You're looking for roughly $100 billion of incremental annual cash flow eventually coming out of AI systems. So, how to monitor these risks and what to look out for? First, unit economics. Look at the AI revenues from these companies and assess if they are growing faster than AI capex. Second, look at EPS versus valuations. Watch the gap between AI-heavy firms' market cap share and net income share of the S&P 500. Analysts already point out that tech's share of market cap has grown much faster than its share of earnings since late 2022. Third indicator would be the credit spreads. Look for stresses, and if they start to widen, it's a big indicator. When market valuations for AI leaders explode, their equity becomes valuable collateral. They can raise money cheaply by using the overvalued shares. Banks and investors are more comfortable lending large sums at low spreads when the stock is flying and earnings look strong. But let's look at the bright side and see why it could be different this time. Investment scale versus GDP. So on the bright side, OpenAI has grown to positive double-digit growth in the past couple of years. Goldman Sachs argues we're not yet in bubble territory, noting that AI investment in the US is still under 1% of GDP, much lower than the 2 to 5% levels seen in past build-out manias like the dot-com. Strong companies. The main AI backers today have strong foundations. Microsoft, Alphabet, Meta, Amazon, NVIDIA are profitable, cash-rich companies, not fragile dot-coms. Real companies and cash flows. In 2000s, the companies did not have a business model. But today, AI tools already have paying users and enterprise contracts. They just need to prove the ROI at scale. Residual value. Even if some bets fail, a lot of this capex is hard infrastructure, data centers, fiber, power upgrades. It just becomes cheap capacity that future winners can reuse. So, where does that leave us? I'd say it works until the earnings disappoint or barn markets start demanding higher yields or investors reprice the risk. But unlike 2000, there's a credible path where some players get wiped out, others consolidate, and the infrastructure left behind underpins a genuine long term AI productivity boom.